There's no turning back. The stock market has become disconnected from the real economy, and what we're witnessing is a spectacle as fascinating as it is dangerous. The markets celebrate as if they were living on a different planet, hovering at historic highs, while the streets tell a story of empty pockets and unpaid bills. The S&P 500 breaks new records as if immune to gravity. Companies announce extraordinary profits, and headlines sell us an economic renaissance that seems indestructible. But at the same time, millions feel that wages aren't enough, that prices are rising relentlessly, and that daily life is an uphill race. It's a stark contrast. Above, a sky of fireworks. Below, a ground cracking beneath our feet. It's like watching an acrobat walk a tightrope while everyone applauds, unaware that the safety net has disappeared. The question is inevitable. What happens when that thread snaps? What happens when the stock market no longer reflects the economy, but rather an illusion that sooner or later may crumble? Today, we're going to explore that abyss together. The divorce between Wall Street and real life, what it means for your future, and why understanding it is more important now than ever. And I want to propose something to you. If you've ever felt like the story the markets tell doesn't reflect your own reality, write about it in the comments with this empowering phrase: "I accept success and happiness in my life." Let it remain engraved as a reminder that, even if the system plays its own game, you have the ability to forge your own path to abundance. GDP as a mirage. Gross domestic product is always presented as the holy grail of the economy. When the government announced that it had grown 3% annually, the media celebrated it as if it were a gold medal at the Finance Olympics. The message was clear. Everything is under control, the country is moving forward with a firm step. But what very few people realize is that there's a catch to this number. Calculating GDP seems complex, but it's actually simple. Add household consumption, business investment, government spending, and exports, and subtract imports. And this is where the trick comes in. Because if a country stops importing, that is, stops buying from the rest of the world, that negative number shrinks, and GDP automatically seems to inflate. Not because the country produces more, but because it consumes less from abroad. That's exactly what happened. In a single month, the United States reduced its imports by more than $80 billion. Think about it. $80 billion that would normally have gone to buying foreign products, from German cars to Chinese clothing, simply disappeared. And of course, the accounting result made GDP rise like a helium balloon. But it's not clean air that fills it, it's smoke. Is this strength? Not at all. It's a reflection of weakness. When families and businesses stop buying abroad, it's not because they're suddenly self-sufficient, but because they don't have enough liquidity to do so. It's a symptom of fear, of a hidden recession. It's as if someone were bragging about having more savings this month, but the reality is they didn't pay the electricity bill, didn't buy food, and froze all their necessities. Are they richer? No, they're surviving. That 3% growth doesn't represent abundance. It represents a disguised contraction. It's the paradox of a sick person who appears to be gaining weight, but in reality, they're doing so because they're retaining fluids. The body isn't stronger, it's more fragile. What the headlines celebrate is, at its core, a warning sign. And the danger is that millions of people read that figure without question, as if it were a true reflection of prosperity, when what it tells us is exactly the opposite. The economy is paralyzed with fear, and domestic consumption, the true driving force, is slowly shutting down. Industry in a sudden halt. The stock market may dance to the rhythm of euphoria, but factories don't know how to lie. The most direct indicator of industrial health is the manufacturing PMI. It works simply. Purchasing managers at large factories are asked if they are purchasing more or less raw materials than before. It's like a radar that detects where production is moving before official statistics confirm it. And the data was devastating. In July, the PMI fell to 48 points. What does that mean? It's below the 50-point line, the boundary that separates growth from contraction. In other words, factories haven't just stopped accelerating, they're hitting the brakes. The chain is very clear. If an auto plant buys less steel, it means it will make fewer cars. And if it makes fewer cars, it doesn't need more workers. In fact, the manufacturing sector's employment indicator plummeted to 43.4%, a level that reflects that hiring has not only stagnated, but has entered a downward spiral. It's the prelude to mass layoffs. Industry is like the heart of a human body. If it beats strongly, it pumps blood to the rest of the organs. If it weakens, the entire body begins to fail. And today, that heart beats with difficulty. The US economy may boast of record-breaking results on Wall Street, but if its factories stop producing, the entire country slowly suffocates. Imagine a train traveling at full speed. From outside, passengers are celebrating, toasting, and singing. But in the driver's cabin, the engine is beginning to lose power. The pressure gauges show low pressure, and little by little, the engine stops pushing. That's the feeling today. The industrial locomotive is coming to a stop, even if the people in the cars don't want to accept it yet. Unemployment, the irrefutable proof. The stock market may inflate, stock indices may reach historic highs, and headlines may boast of growth, but there is one statistic that never lies: employment. Work is the irrefutable proof of an economy's health. Because behind every number, there are families, projects, dreams, and, above all, the dignity of millions of people. In July, barely 73,000 new jobs were created in a country of more than 330 million inhabitants. To put it in perspective, that figure is equivalent to filling a medium-sized soccer stadium while millions wait for an opportunity. It's a drop in the ocean. Statistically, it's almost irrelevant, and humanly, it's almost a cruel mockery. Official unemployment stood at 4.2%, a figure that, while it may seem moderate in historical terms, hides a greater tragedy. What's really worrying is long-term unemployment. 1.8 million people have been searching for work for more than 27 weeks, or more than half a year, without success. These are people who have sent hundreds of resumes, attended interviews, received silence and rejections. Behind every number, there is someone who goes to bed with the uncertainty of not knowing how to support their family. This is the Achilles heel that rarely appears in official speeches. Because an economy can manipulate its growth figures, it can play with the makeup of GDP, it can inflate expectations with stock market indices, but it cannot hide the reality that millions of citizens are unable to find decent, stable employment. This is the deepest fracture, the point where the truth is revealed, an economy broken from within. Imagine a building with an impeccable facade, clean windows, lights on, a neon sign proclaiming success. But upon entering, you find empty hallways, abandoned offices, and workers who are no longer there. This is the economy when it's measured only by the stock market and forgets about employment. The form may be impressive, but the substance is empty. Employment isn't just a number on an Excel spreadsheet. It's the bridge that connects people's efforts with the hope of a better future. And when that bridge breaks, it doesn't matter what the markets say. What really exists is a society that is beginning to fracture from within. The drowned consumer. If employment is the foundation of the economy, consumption is its engine. In the United States, almost 70% of GDP depends directly on household spending. Without consumption, there is no growth, and without growth, growth ceases to exist. Today, that engine is seized. Consumer confidence, the indicator that measures how citizens view their present and economic future, fell to 60.7 points, one of the lowest levels in decades. To understand this, when this index is above 100, it reflects optimism and a willingness to spend. When it dips close to 60, it means that the majority is living in fear, with uncertainty, and that every purchase is scrutinized. The numbers already reflect this. In July, retail sales grew by just 0.5%. At first glance, it seems like a slight expansion. But the context changes everything. With cumulative inflation around 3.2% annually, this growth doesn't mean that people are buying more, but rather that they are paying more for fewer products. It's as if the same $100 bill that once filled a shopping cart could barely fill it today. The trap is cruel. Wages haven't grown at the same pace as prices. While inflation devours purchasing power, families are going deeper into debt to cover basic needs. Credit cards in the US already accumulate more than $1.2 trillion in debt, with interest rates exceeding 20% per year, making the average consumer a hostage to their past spending. The consumer is caught in a vice. On the one hand, inflation that makes essentials more expensive. On the other, debt that multiplies. And so, although analysts talk about consumption growth, the reality is that what exists is a desperate effort to maintain an increasingly expensive lifestyle with increasingly limited incomes. An economy that depends on consumption to survive cannot sustain itself if its consumer is drowning. It's like a car trying to travel miles on an empty tank. Every step forward slows. Every effort uses up the last of its reserves. And when the engine stops, there are no statistics that can hide it. The real estate market is collapsing. If you want to measure a society's confidence, don't look at the stock market or official speeches. Look at the houses. The real estate sector is the most honest mirror of a people's well-being because it reflects something deeper than numbers. It reflects whether families believe they will have a stable future to sustain a 20 or 30-year mortgage. Today, that mirror shows cracks. In cities like Miami, Austin, and San Francisco, the market is frozen. For every 100 homes listed for sale, 59 end up being withdrawn because there are simply no buyers able to pay the installments. The problem isn't a lack of supply, it's a lack of real purchasing power. Mortgage rates hover around 7% annually, a level not seen since the early 2000s. To put that in perspective, a $300,000 mortgage, which a few years ago cost around $1,300 per month, now costs over $2,000 per month. In other words, the same roof costs almost twice as much, without salaries having doubled. The average time to sell a house is now 88 days. In a healthy market, that period rarely exceeds 30 or 40 days. This means sellers wait, lower prices, negotiate, and still no buyers arrive. What was once the American dream has now become an impossible burden for millions of families. The impact is twofold. Construction companies halt projects because they are uncertain about selling their homes. And banks, even though they earn more interest with high rates, see the risk of default grow. A vicious cycle where neither the seller nor the financier has security. The real estate market is more than bricks and mortar. It is the thermometer of social trust. And today, that thermometer is reading high. What should be a symbol of prosperity, like owning a home, becomes a painful reminder that the economy punishes those who want to build more than those who speculate. Small businesses in survival. Behind every grand, illuminated avenue, every city boasting modernity, the true economic heart is not multinational corporations, but small businesses. Cafes, workshops, hardware stores, bakeries, family offices, they generate more than 60% of private employment in the United States. But today, this productive fabric is in survival mode. Demand is so low that many have stopped hiring. They prefer to survive with minimal staff, squeezing every penny, rather than risk growing in an environment where customers are spending less and credit is increasingly expensive. A clear example is commercial loans. The average rate for a small business exceeds 10% per year. This means that to finance a project of just $100,000, the entrepreneur would have to pay more than $10,000 in interest alone each year, with no guarantee that their sales will match that effort. The result is evident. Less investment, less expansion, and, in many cases, silent closures. This phenomenon is the clearest sign of what some economists call a silent recession. It's not an abrupt collapse, not a crisis that appears overnight, but a gradual blackout. One business isn't hiring, another quietly closes, another reduces its hours. Like small lights that go out in a city until the gloom becomes evident. When entrepreneurs stop taking risks, it's not for lack of ambition, but because the horizon darkens. And that is perhaps the most worrying warning. If those who support the foundation of the economy stop believing in the future, the entire edifice loses its foundation. Therefore, faced with this reality, it's important to plant a different truth in our minds. Leave your thoughts in the comments with this affirmation: I am prosperous and I attract wealth. Write it as a reminder that real prosperity is built from the bottom up, from ordinary people, and not from the top of a pyramid that is always more fragile than it appears. The weight of inflation and interest rates. Inflation is like an invisible burden spread across all pockets. Although headlines claim that core inflation has moderated to 3.1%, the reality is that this figure is still above the Federal Reserve's 2% target. And as long as that goal isn't reached, monetary policy will remain harsh with high interest rates. And what does this mean in real life? It means unaffordable mortgages. A mortgage rate close to 7% turns the dream of buying a home into a pipe dream. It means unaffordable credit. From credit cards with interest rates exceeding 20% per year to personal loans that stifle more than help. It also means stifled small businesses because financing inventory or expansion becomes too expensive a gamble. In theory, raising interest rates should cool the economy to contain inflation. But in practice, it feels like putting out a fire with gasoline. Every time the brakes are applied, the economy becomes more fragile, and what is achieved isn't so much to lower prices, but rather to weaken those with the least leeway. Indebted families, small entrepreneurs, and young people looking for their first home. The paradox is cruel. While interest rates rise, the prices of basic goods don't fall at the same rate. Buying food continues to cost more. Filling up the car's gas tank continues to drain wages, and daily life continues to be a strain. It's as if the economy as a whole is being punished, but the benefits of this correction will never reach the pockets of ordinary citizens. This is the current dilemma: how to balance an inflation that doesn't fully subside without breaking the backbone of the real economy. Because statistics may show that prices rose only 3.1%, but anyone who goes to the supermarket knows their cart weighs less, even if the bill is higher. The fragility is there. A society that feels that every financial decision is a minefield, and if the foundations shake, the entire building risks collapsing. History always rhymes. Mark Twain said that history doesn't repeat itself, but it rhymes. And today, the rhymes sound all too familiar. The current scenario is reminiscent of other bubbles. The dot-com bubble in 2000, when the promise of the internet seemed endless. And the financial bubble of 2008, when easy credit and real estate speculation disguised themselves as eternal prosperity. In both cases, the narrative was the same: euphoria, promises of a new era, forgetting basic principles. In both cases, millions believed this time would be different. And in both cases, the end was identical: a brutal clash with reality. Today, we see very similar ingredients on the table. A stock market that ignores signs of fragility in the real economy. Households in debt at record levels. Companies valued more by expectations than by fundamentals. And governments betting that confidence will last longer than it can. It's a choreography we already know. The big question is when. No one can accurately anticipate the moment of adjustment, because bubbles tend to inflate much more than logic would allow. But the inevitable is that sooner or later they burst. And when that happens, what seemed like wealth evaporates in weeks. Therefore, rather than trying to predict the future, the true strategy lies in acting consistently. A proven tactic is dollar-cost averaging, investing periodically, regardless of whether the stock market is up or down. It's like filling a jug drop by drop. Slow, patient, but inevitable. Over time, this consistency overcomes euphoria and even the crashes. That is the difference between those who are swept away by each cycle of hope and fear and those who manage to weather the storms with serenity. History always rhymes, but each person chooses whether they want to be a victim of its repetition or a student of its lessons. And here I want to invite you to leave your mark. Write this statement in the comments. Nothing stops me, everything drives me. Do this as a reminder that, although economic cycles are inevitable, your perseverance and long-term vision are the true tools for prosperity. What we are experiencing today is not prosperity, but a carefully crafted mirage. The stock market may shine like an artificial sun, but the real economy, the one we experience every day, is marked by deep cracks. And yet, amidst that darkness, there is an eternal lesson. Perseverance conquers uncertainty. Discipline conquers fear. If this message resonated with you, it's because you're ready to look beyond appearances. Subscribe and join me on this journey. What lies ahead will be intense, and together we can navigate it with clarity and purpose. What we are experiencing today is not prosperity, but a carefully crafted mirage. The stock market may shine like an artificial sun, but the real economy, the one we experience every day, is marked by deep cracks. And yet, amidst that darkness, there is an eternal lesson. Perseverance conquers uncertainty. Discipline conquers fear. If this message resonated with you, it's because you're ready to look beyond appearances. Subscribe and join me on this journey. What lies ahead will be intense, and together we can navigate it with clarity and purpose.